Welcome to the daily update, where I'll go over the action in the market for Tuesday, June 10th, and we'll see how things look for Wednesday, June 11th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, another update. We're still looking positive. We're not trending though. And we're seeing a little bit of internal weakness coming in, and I'll show you that as I go through the charts. But the big story for Wednesday is going to be CPI, and then, of course, the market's reaction to it. There's this cautious optimism that something good is going to come out of the U.S.-China trade talks. They're still going on, and they plan on continuing Wednesday. So much for a 5-minute little chat, but that's kind of how it sounded over the weekend. But apparently, as they're talking, that's usually a good sign. Let's hope that they lead to something there that the market can react to. And then we have probably the second most important economic report of the month, CPI, coming out. And then also very important, I don't know if I'd call it the third most important, but still quite important, is PPI. And it depends. Sometimes that is more important if the market really reacts to it. Other times it just kind of comes and goes, because the big one is CPI. And then, of course, like last week, we had the employment situation report. And then all the other stuff that we look at going throughout the month that we just kind of put together. And some are more important, some are not quite as important. And the market determines what's important and what's not important. Okay, so let's go back and talk about what happened. We did have a higher open. We got up to R1. Now, the pivot points were not very wide because Monday's session was not very wide. And Tuesday's intraday pivot points are calculated based on the open, high, low, and close from Monday. So it didn't take much to get up to R1 at 6,020. Then we pulled back. So there's that little retreat coming back down. But then we were able to resume the climb and get up to R2 at 6,034. We pulled back again, coming back down to R1. So now this is a level that worked as support. Then we climbed and actually got above R2, and we closed near the intra-high of the day. Now, it looked like there was some late day selling going on, and there was, but then the very last bar to close the market, we saw a nice little upthrust, and that helped to improve things that way. We were up 0.55%, still below average with volume, still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 period moving averages. And I sound like a broken record when it comes to that. We are seeing interest rates under that 4.5% level with the 10-year yield, so that's helping. And we'll get the big read, latest read anyway, on inflation in Wednesday's session. And then waiting to see what kind of talks come out. All right, so there's ongoing hope for a positive outcome of the trade talks between the U.S. and China. I already talked about that. President Trump's acknowledgement that Iran is becoming much more aggressive in its nuclear talks. Okay, now Iran's been a problem for the U.S. since 1979 when they took over the U.S. embassy there. And so this has been an act of contention now for a long time. And then you get Israel in the mix. And of course, they're not really all that good of friends at all with Iran. And the big thing is we need to stop Iran from getting a nuclear weapon. And that's been a source of contention over 20 years now that Iran has been trying to do this. And there's rumors that you hear out there that Israel may go in and attack Iran and try to take out any nuclear facilities that are similar to what they did in 1981 in Iraq when Saddam Hussein was building a nuclear power plant there. Israel, without the U.S. even knowing about this, Ronald Reagan was the president at the time, they took some fighter jets, went in and just leveled the nuclear power plant, which was it was France that was actually building the nuclear power plant. It was a French company that was building it in Iraq. But kind of interesting. So there were some words coming out about Iran getting more aggressive with their talks, and we saw a really brief downward move in the intraday price, but then it went right back up. So then later in the day, Commerce Secretary Lutnick said that talks with China are going very well and could continue into tomorrow. Small caps had another pretty good day. Now they're hitting overhead resistance and now coming back down a little bit. I'll show you that chart. And the semiconductors, this is promising. If we want the big stocks to go in the lead, which they seem to still be doing with the mega caps, we need semis to do even better. And they are for right now. We'll see if we get more follow through with that. The VIX is still below 20. We're in the 16 range, the high 16s now. And we're still looking at our list here that is showing good positive momentum. We're not trending, but we're seeing pretty good momentum as measured by the Stochastic RSI, Williams percent R, both CCI charts. The stochastics, we're still far away from the 20 period moving average as measured by the boom indicator. And now the RSI short term is starting to get extreme. Intermediate term, a new addition to the list is the CMB composite. We're also getting up into the +3 channel with the standard deviations chart. That's a new addition to the list. And then the momentum oscillators, just kind of drifting along sideways. The PMO is still extreme positive. We have other momentum oscillators that are extreme positive. And then the S&P and NASDAQ 100 bullish percent index. Now, for the S&P, it's still extreme positive, but it's actually come down and it's dropped below its moving average. So that has now turned negative. That's something that we were latching onto that was more positive, seeing internal point and figure buy signals being generated in the S&P. That declined. So on Tuesday, and we're also far away from the 50 period moving average. No change to the overall scenario with the Fed. They're still there. They're still doing things. They're still important, but they're kind of taking a backseat to what's going on in LA and what's going on with the administration and the trade talks. The dollar was up and interest rates were down, not very much. We were at 4.47% with the 10-year yield, where we had been at 4.48% after Monday. But we're under that 4.5% level. So that's giving some support to stocks. Sentiment is still positive. We're up, not in the extreme positive area. That's when we get closer to 75. But we did tick up a couple of notches from 62 up to 64. And we're still not trending, both in the short term and the intermediate term. So that's why we're out of that range. The chart pattern, and I'll point it out again, as I've been trying to say, is that we're seeing higher highs and higher lows. That's a pretty good signal, but we're not seeing an awful lot of conviction behind it. But you have the buy the dip. That's really, anytime there's any kind of weakness, you got these folks that just come flying right in just to buy something because they see it being at a better price. And that's kind of been working lately. I'm not a fan of that. It's not what I implement. I don't agree with it because it could work 6, 7, 8, 9 times in a row, but that last time it could just wipe everything out, because when it goes against you, it can go against you pretty severely. But there's people that disagree with that. They feel like they're buying something on sale. But we're not trending now. We're still below 20 with the ADX. We're below the moving average, both in the short and intermediate term. With the update, the bias is positive. I'm keeping the momentum still here at mixed. And the reason I didn't change that is, yeah, we could probably change that to positive, but without a real convicted trend right now, it's like the market still is opening itself up to be vulnerable. All right, so we just had the NFIB Small Business Optimism Index that came out, 98.8. That's an improvement. So that's encouraging. Now, this doesn't really drive the market overall, but it is something, since most people work for small businesses, if they're starting to feel a little bit better, that usually means the people that work there are feeling a little bit better, and that's a good thing. So here's the chart of that, where we've been seeing a steady rate of declines going all the way back to December. This is the first bounce up that we've seen in a while. And then we have a number of charts here. The weekly chart of the overbought, oversold composite starting to get a little pricey. We're above that 70 level coming into 75. Once we break above 75, that's where it starts to get extreme positive there. And then this, yet another sign. This is a bull market. I did show this before. When we've had 20% gains for 2 months or more, going back to 1950, the results are good. And the further out you go, the higher the winning rate and the higher the return. Then intra-year declines versus calendar returns. It's when we how we closed out the year versus declines that we're seeing during that year. Well, they have it down here 19%. Okay. We were right around that level, 19, 20 on an intraday basis, 21%. And now we're back up to being positive on the year, at least for the S&P, when this chart was created, up 1% year to date. And they seem to be showing a lot of this too. These are valuations. I usually hit this in the intermarket analysis video over the weekend, but they seem to be continuing with a lot of these charts where we now have the S&P since it's been going up. We use that 10, 15, 20 scale. And when we get to 20 or above, the market is considered overvalued. But as I always say, we've seen that now for years. So it's not really very useful as a timing mechanism. It's more just for information. So the S&P is at 22. You also have staples, which are actually coming down a little bit. They're still overvalued though. Industrials, discretionary, and then tech. And people like that tech is overvalued because that's a real growth area. And when you really get the market moving to the upside, they don't mind buying something that's already expensive if it's going to become even more expensive. That means they're experiencing some capital gains. And then at the bottom, even though energy had a good day on Tuesday, it's still, from a valuation standpoint, it's actually underneath a little bit the fair value level. All right, and then I did show this yesterday too. As I mentioned, there's some charts that I get from one source, other charts from a different source that are like a day newer. So it's pretty common for me to show like this chart yesterday, excuse me, and then Isabel Net ends up using it as one of their charts for the next day. But this is actually more positive. This just shows that cyclicals, which cycle with the economy, they're doing better. And that means that these companies are anticipating the economy still holding up. When we were going down here from the end of December into the lows in April, everyone, not everyone, but there was fear that the economy was going to be falling apart. And that's why we saw this ratio really coming down. And now it's starting to improve. In earnings sentiment, I also showed this chart. No, I don't think I showed this one. This is the S&P. This is the one that we pay most attention to. And this is how people are feeling about earnings. And it's improving, even though it's been tipping over a little bit with this latest chart. And then JP Morgan strategists lower than raise. Okay, they're Wall Street people and they are professionals, but they're not necessarily the professionals that drive the market. So these are just human beings that react to what's already happened, just like a lot of people do in the markets. And so when we're going down, they're going to put their projection down. When we're going up, they're going to raise their projection back up. And it just flip-flops back and forth. Then U.S. stocks have rebounded since Trump ended up pausing the tariffs. We had the really big down move, and then news was still coming out, but it wasn't taken as negatively, and so we've been rebounding not only with S&P, that's U.S., but then the global stocks have also been improving. That's the blue line that we're seeing. And then here's New York Fed coming out with this sentiment. No, I'm sorry, this is not the New York Fed. This is Goldman Sachs. I don't like a lot of these what I call dot charts, splatter charts, because they're all over the place. And it's like, how in the world do you make sense of this? But this one was a little bit different, I thought, because institutional investors, this is the smart money, and they're tending to feel more positive about things. Now, Hedge funds are also included in that. I don't include them in the smart money, even though they're more big money. But if you kind of look at this in a general way, the big money tends to feel more positive about things, where you have retail, that's individual investors, people that do their actions through a broker directly, they're not feeling as positive. They're still a little bit more pessimistic, which could actually end up being more positive for the market. Okay. And then risk parity, it had really been coming down as stocks were going down. Now it's starting to turn back up. Folks are willing to assume more risk. They think, okay, the market's going to go up. The economy's still looking okay for right now. Let's sink some money into stocks. Then we did get the NFIB Small Business Optimism Index. This is just showing, this is a little different way of showing the chart that I just showed a moment ago, how it had been really coming down. Now it's starting to go back up. And then the S&P versus when the big economic reports are released, and that includes CPI, the non-farm payrolls, that's the employment report, and then when the Fed is coming out. And those are the most volatile days. And we see them really start to pick up and be more volatile than what we see on other days. And that could be why we're a little bit quiet right now, even though we are tending to go up. We'll see if volume can pick up after CPI's release. And then the earnings here, the revisions breadth as they're coming, analysts are coming back in and saying, well, maybe things are looking a little bit better. Where it had been going down, now it's starting to go back up. And it's also improving when you look at short and going further out into the revisions. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here's the chart. We did have a higher open, not a real gap, not a lot of gyration right at the open. We started to go up, actually got a little bit above R1. This, I believe, was right about the time, like Iran's making some noise. We dipped down really quick, but came right back up. Then we were able to make our way up to R2, but then we fell back down to R1, actually fell a little bit below that. We did see some late day buying, but then it led to some even later day selling, but then a nice little bump going into the close. The close just a little bit off of the intraday high. And just kind of subdued right now as far as the initial overnight session. We'll have to see how things play out. There'll be a lot of anticipation for CPI likely. The lines are getting a little bit closer here with our growth to value chart. The blue line and the red line, they were a little bit farther apart. Now, some of this is skewing because this chart's getting a little bit longer. And so these lines look like they're getting a little bit closer together, but more drastically than what we would have seen when this chart didn't show quite as much. But we are seeing a little bit of tightening up here, and that's a little bit of a concern there. And we have been drifting back a little bit recently with the growth to value ratio intraday for the S&P, but the bigger picture is that this is still going up, but it's starting to flatten out a little bit. So growth was up enough less for the large caps. It was actually down for the mid caps and up quite a bit less for the small caps. So it wasn't necessarily a good day for growth. We saw value actually doing better in Tuesday's session. So we're coming back down here with the end of day chart for the small caps, mid caps, and the S&P. But these lines are right on top of each other. If you look over on the left, the 50 and the 200 have the same value right now. So unless we see a massive drop really quickly, and even then, we're probably still going to see a golden cross because these lines take longer to move. And still holding up okay with this growth to value ratio above the rainbow, and seeing some improvement with discretionary to staples with the equal weight. That's helpful. And I haven't shown this in a while. I did talk about it over the weekend, but we look at the weighted version of discretionary to staples. That means that Tesla and Amazon count for the most part, the biggest move of discretionary. But we're turning back up. Now, Tesla has pretty much been able to recoup about all of the percentages that were lost last week. It was down over 14%. It's come back just about by that much. I'll show you the chart later. And we look at the equal weight version. So instead of including Amazon and Tesla, where they make most of the movement of the sector, this looks at all of the stocks in the sector the same. This is improving. We are seeing some improvement with the tech to utilities ratio. That's growth and that's positive. Where we're seeing a little bit more of an improvement here is the biotech, which is growth compared to healthcare. And a lot of that has to do with weakness that we consistently have been seeing in healthcare. And a bit of an improvement here with hotels to utilities also. So when these ratios are going up, that's more pro-growth, that's more positive for the market. All right, here is the trend still, even in the short term, just kind of flatlining below 20, below the moving average here with the short term, and also still continuing to go down here with the intermediate term, but we default to positive with the green line above the red line, still below average with volume, still below average, or still on a daily basis here with volume just continuing to drop off, and it might even drop off even more the deeper we get into summer. Sentiment still under 20 with the VIX. That's positive for stocks. And the VIX of the VIX continues to decline, even though it ticked up a little bit in Tuesday's session. We're declining with this fear gauge and actually declining, but a little bit less here with this other fear gauge. So we're seeing some more fear coming out of the market. There on the daily equity put call ratio chart, we did see a little bit of a move up here. That could be some pre-CPI hedging that's going on, but we're continuing to go back up with the 5-day chart, and this data is just crazy. They must readjust it or something. It's the last data that I get. It's one of the reasons I have to delay recording the video, but I could come back later on and look at this chart and it would be telling something different. And we're also ticking back up a little bit with the 10-day chart. And this is more positive. We're seeing more risk on. This is when the bigger stocks are being more favored, and we see this ratio going up. And this has been continuing to improve. And we're also going up with the high beta. The high beta, these are the stocks that outperform the market on the way up. Unfortunately, they outperform on the way down, meaning they go down faster. But this ratio, compared to the more stable or conservative stocks, continues to go up, and that's more positive for the market. We are seeing a continued drop off here with the momentum stocks, where they had been showing some improvement along the way. Now they've been seeing some weakness, and we're still down at the lower end, actually dropping a little bit below the band here. When we look at volatility risk premium, that just means that fear is still tending to come out of the market. Advanced decline line still looking good based on price and volume. We actually declined a little bit with the advanced decline oscillator, but we're still above zero. So it's positive. Now, the advanced decline ratio, we're going up both with the short and intermediate term chart. And the new highs minus the new lows, we're contracting now a little bit with the new highs. Really no expansion of new lows. So we're rolling over just a little bit with the 5-day chart, but we're still going up. And we're flattening out and slightly declining here with the 10-day moving average. And we're back to looking a little more positive with accumulation distribution, but not an awful lot of conviction as shown by the boom indicator. Now, if you just look at the indicator and the moving average, that's positive and going up. But we're just chopping along sideways. This tries to pick up the movement between the indicator and the moving average. Not a pure measure, but it does give us a fairly good idea. And where we were looking more positive with the Chaikin money flow after Monday, now we're turning back and looking negative. This is on an up day like we saw. We actually saw the histogram coming down. Now we've been going down with the Chaikin oscillator, and it's starting to turn back up. Isn't that interesting? But we're not quite above the moving average yet. And a little bit of an improvement with the vortex, not so much with the green line, but we're seeing the red line coming down here. And then I'm trying to pick out the advanced decline studies that we do. Here's the cumulative advanced decline line for the S&P, not breaking out to a new high yet, but going up. But if you look at this based on volume, we are now setting a new all-time high. And this is longer term, a 10-day average of the highs and lows for the S&P. We're above the green line. That's a little more intermediate to even somewhat long-term positive. If we can stay above this green line, that shows good upward momentum longer term. Still looking okay with the advanced decline lines across all the different indexes. And then the NYSE cumulative advanced decline line, it is setting a new high based on price. Also now setting a new high based on the regular way that the NYSE is being calculated, where the top one is a cumulative advanced decline line. This is also another version of the NYSE advanced decline line, setting a new all-time high here. And then we break it out based on common stock. We're going back up, but not setting a new all-time high on price, but we are setting a new all-time high based on volume. And still looking okay with those stocks in the S&P above their 20-period moving average. Awful choppy lately. That's more short-term gyration that we've been seeing. But for right now, it's looking more positive. And we're actually, as I've been pointing out, the intermediate term trend is still hanging in there. We're not trending, but it's holding up with our other indicators that we follow. And we see that by the number of stocks in the S&P above their 50-period moving average is continuing to go up. We're also showing an improvement with the 100 and 200 period moving average studies. And then this is a broad market measure, a little shorter term, but broader, where we take a 5-period. The other chart's a 10-period moving average. This is a 5-period moving average of the highs and lows across the broad market, and that's continuing to go up. So we're above zero. So that is positive there. All right, here's the daily chart. Now, as I've been saying, we've been setting higher highs and higher lows here. That's pretty good, but the ADX is still not picking up a trend. However, you notice we have this dashed line right above current price that may be acting as some kind of overhead resistance. Now, this is a previous pivot point. We now have the pivot points that are being calculated for June right now that we really haven't come into those yet. And then the moving averages on 20, 50, and 200, they're all improving with the S&P 500. The Stochastic RSI, the second day now that this chart has been on here on the list that we have, and that's showing good short-term momentum. The Williams percent R has been on here a little bit longer, good short-term momentum. The CCI 14 and the CCI 20. The force index just coming right back up to its midpoint, but it's positive since we're above zero and it's green. And we're still extreme positive on all the three subdivisions of the short-term time frame with the stochastics. The improvement continues with the short-term moving average based on 20 periods. We're seeing the green line and the blue line continuing to go up. We're just getting now into the +3 channel with the standard deviations chart. Now, the balance of power, which declined on Monday, actually bounced back up in Tuesday's session, and it's still above zero. So that's switching back and looking a little more positive. We're starting to go above the black line here with the CMB composite. That means we're getting extreme positive and still looking okay with the bow tie. The fluorescent green moving average is still going up after it had been going sideways. So this shows that there's some kind of a trend. It's just the ADX that we use to measure the condition of the trend. That's not showing anything. We're positive with the go, no go, since it has the darker blue bars. We're also hitting the highest high value here. That's positive. Now this trend, the Landry light, continues to be positive, as does the proper order. But the TTM squeeze, now it could be bottoming out here. We're seeing, instead of a declining bar, we're actually seeing the same bar that we saw after Monday. But still, this is taken as negative. And we're coming right down just a little bit positive with the ease of movement. The Arun is still positive with the oscillator above zero, crossing back above zero again with the S&P McClellan oscillator and continuing to go up. So that's showing a little bit of internal improvement. So we're going back up with the summation index based on price and volume. A little bit more strength in the broader market. The NYSE McClellan oscillator continues to advance. So we're going back up with the summation index based on price and volume for the NYSE. Leveling out a little bit here with the Swanland trading oscillator based on price, but still continuing to advance based on volume. And we're seeing an improvement here when we break out the price momentum oscillator based on price and volume. They're starting to turn back up. And the PMO is still drifting higher, but it's above this red line. That's why I say it's extreme positive, and it's still above its moving average. Seeing a little bit of improvement, crossing back further above 50 with the PMOs that are rising, above 50 with the buy signals, and starting to turn back up with the PMOs that are above zero. Positive with the Elder's Impulse system for the S&P, positive with the parabolic SAR, negative with the slope oscillator, but possibly now trying to level out, but it's still below its moving average. Still drifting, but trying to improve a little bit with the MACD. So here is the short-term oscillator, the slope. It's still negative, but trying to improve. Seeing a little bit of a turn up here with our other short-term oscillator, the TSI. Flat with the MACD, flat but still above the moving average with the PMO, flat to declining with the PPO, and flat to declining now with our longer-term oscillators, the TRIX and KST. Negative but improving with the Copic curve, still up in the green area with the Sean trend meter, above 50 and now advancing with the money flow, but declining, but above 50 with the ultimate oscillator. On balance volume is still positive. And we're positive with the intermediate term RSI, but we're starting to get above the blue line here, getting extreme with the RSI based on 9 periods. Still working off of a pring bottom fisher. That's a buy signal. So we'll see if we don't know yet. I mean, it looks like it could be good. We've gone up since these lines crossed, but this is supposed to pick a big move to the upside, not just some kind of inching move up. We're still positive with our moving averages. We're positive in the intermediate term based on 50 periods. The red line and blue line continue to go up. We're still far away from the 20 and 50 period moving averages. And this is where we're seeing the decline in the bullish percent index for the S&P. It's actually coming down and crossing below its moving average. A little bit of a concern there. But we're still going up with the NYSE bullish percent index and declining a little bit, but still extreme with the NASDAQ 100 bullish percent index. Longer term, the weekly chart of the S&P still looking pretty good here as we continue to go up, but this is a weekly chart, so it's not official until Friday's close. But the trend based on this, the Heiken Ashi is still looking positive, as is the Kagi, the Renko, and the three-line break. Long term, still moving a little further above the midpoint here with the 150 and 200 period moving averages. Still negative in the long term with the mid caps and small caps, and switching back to positive here with bonds based on price, because interest rates have been going down. That means bond prices are going up. And we were looking a little more positive with commodities. Now we're just looking at short-term positive, where the dollar is still negative on all time frames. And industrials, a little bit of profit taking there lately. That was the sector that ended up being down. We did see a nice little bounce from energy, even though oil declined. But communication, discretionary, those are growth areas, and they were part of the leaders. Tech was up, but up quite a bit less. And then we had the NYSE doing a summation index crossing above its 20-day simple moving average. Okay, so that's turning back a little more positive in the short term. Oil did decline, ended up closing down below 65. Then what happened during the day, we had the NASDAQ going above 19.6 and then 19.7, and Canada set another new all-time high. Here's the market carpet. Saw a little bit of profit taking in Microsoft here, but Nvidia and Apple, although not huge gains, they were positive. And then we look at discretionary, where Amazon was up and then Tesla was up 5.67%. So that helped discretionary to improve. And then with communication, you have Google and Meta in here actually showing some improvement as well. And this is improving, but we're still seeing a little bit of a disconnect. Even though we're seeing volume on the NYSE and the broader market actually possibly leading price, we're still seeing the equal weight S&P underperforming the weighted version. Now they're both going up, and that's positive, but we're seeing them a little bit far apart from each other, even though they're on different scales. Still above the 200-day moving average with the Dow, positive with the Elder's Impulse system for the diamonds. Still looking pretty good from a chart formation process here with the NASDAQ. And we're positive with the NASDAQ with the Elder's Impulse system. Looking pretty good here with the NASDAQ 100. That's more encouraging. And positive with the Elder's Impulse system for the Qs. But the momentum for the NASDAQ 100 continues to be negative. The PPO is trying to ever so slightly turn up, but it's still below its moving average. And here's where the small caps, they came up, they broke above this R1 resistance level and came right back down and settled at that area. Now we're hitting the 200-day moving average with the Russell 2000 small cap index. Now for years, this is the only index that I followed. But then the Russell company ended up changing ownership, and there were some changes done to the index, so I didn't use it as much, and so I started to follow this previous one, the S&P 600. Well, now most people still follow the Russell 2000. So this could be kind of a big deal because the 200-day moving average, it acted as support a couple of times. Will it act as resistance here? Positive though with the Elder's Impulse system for the small caps coming up to the 200-day moving average. Not quite there with the mid caps, and still positive with the Elder's Impulse system for the mid caps. Wilshire 5000 still doing pretty good, up 0.5%, looking improved there, as is the total U.S. stock ETF. Financial sector in an uptrend, but just kind of chopping sideways. We're still a little bit concerned because the financials continue to underperform the S&P. And that it's like, okay, what's going on there? When this is going up and actually outperforming the S&P, that tends to be more positive. But that's not what we've been seeing lately. So we're just keeping an eye on that one. Where the FANG index, it was up a little bit, but it's just coming off of setting all-time highs and generating a recent golden cross. Okay, so Apple was up 0.61%, but in a downtrend. Amazon was up 0.29%, above both moving averages. Seeing a golden cross now with Microsoft, even though it was down a little bit, it's still above both of the moving averages. Google is in a downtrend, but up 1.43%. Meta also in a downtrend, but you see the blue lines trying to come back up and possibly cross above the red line. Nvidia was up 0.93%. This is what helped the market go higher for the S&P. Tesla, you can see it's right, actually a little bit above where it was before it started the big move down last Thursday with the Trump Musk tiffs. I haven't been really paying attention, but it seems like that's kind of gone out of the pop news cycle now. I'm sure it's somewhere in there, as the LA riots are now the current pop news cycle, even though it's a very serious situation. Seeing a little bit more profit taking with Netflix, but still, this has probably been the best looking chart as we've been trying to go up in 2025. And the staples to tech ratio still continues to go down. That's positive. And the semis to tech ratio is going up. We're breaking out a little bit here, seeing some improvement. We want to see more. We've seen this improve previously. We need to see this continue to go up, kind of similar to how we saw in early 2024, at least halfway through the year. If this could really kick into gear, that could be quite positive for the market. And kind of looking at the world versus U.S. stock correlation, still fairly strong, even though it's dropping back. Still seeing a gradual improvement with the longer term correlation. And we were down with oil, but still into the mid 60s. The dollar is continuing to be in a downtrend. And when we look at trueflation, they're coming in at 1.93%. We'll see if that gets changed with the CPI report coming out. And we're back under 4.5%, even though we opened at the low, closed at the high. We were still down on a closing basis, but we continue to be below this red line, which is the 4.5% level for the 10-year yield. And not really moving all that much here with the 10-year based on price. Still looking okay with our growth to value ratios. We're improving, but still negative with discretionary to the S&P. But when we look at the Qs to S&P and large cap growth to value, those are still looking positive. So our indexes are positive. Even though the small caps came down, they're still above the advancing moving average. And we're improving slightly here with the S&P outperforming the utilities. That's positive. And the staples to S&P ratio, we want this to go down to be more positive, and that's actually what's going on. All right, so what's the outlook then for Wednesday? I haven't changed this. We're still positive in the short, intermediate, and long term, but we're not trending. We're going to get the weekly MBA mortgage applications index and then CPI. That'll be the big one there, as well as Treasury budget will be coming out later on. And then anything that may develop geopolitically, either outside of the U.S. or something more, especially in the California area. And then you have this expanding into other cities, these protests as well. And is that going to cause some problems there? All right, then on Thursday, we'll get initial jobless claims as well as PPI with consumer sentiment coming out on Friday. Here's a look. We're finally coming into the important part of the week, economically speaking. Seasonality negative for the Dow and S&P and neutral to negative with the Nasdaq for June 11th. So not real good historical seasonality there. And then we see a little bit of negativity coming in here before we see a slight bounce. But then as we start to work our way into the middle part of June, this is where we see some more, at least historical seasonality that occurs during a post-election year. And then we're just kind of seeing things being pretty lackluster here and probably going to get even more so as we go into summer. And then again, this is fuzzy here. We're up 56% of the time going back to 1950 with the S&P with a return of 0.2%. We're up 7 out of 18 times, down 11 out of 18 times with a negative return going back to 1950 during post-election years. Here are the pivot points for Wednesday's session. So I'm still keeping the smart money indicators on the negative side for right now. Accumulation distribution is positive if you use it just by based on where the indicator is to the moving average. But if you look at the boom indicator, we're just kind of chopping along. So that one is positive, but we're negative with the Chaikin money flow. We're turning down. We're improving with the Chaikin oscillator, but we haven't crossed back above the moving average yet. And we're still negative here, but we could be getting close to a golden cross with our long-term growth to value ratio. And we're still holding up above the moving average with the discretionary to staples ratio. The Copic curve is negative, although it's trying to improve, as is the longer-term special K and the momentum for the NASDAQ 100. On the positive side, we're negative with the S&P. Even though it's still extreme positive, it's coming down below its moving average, where the NASDAQ 100 is holding up and the NYSE bullish percent index is actually improving. And then the S&P and NYSE McClellan oscillators and summation indexes are positive, as is. Now, I'm kept this Swindon trading oscillator positive because we haven't actually gone down based on price. We're just flattening out right now. The parabolic SAR is positive, the oscillators, but they're just drifting. Then we have the ease of movement, money flow, ultimate oscillator, vortex, financial sector, and then the buy signal generated by the Pring bottom fisher. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So the conclusion, not any changes. Positive, but not trending in the short intermediate term, and we continue to be positive in the long term because we're above the 20-period simple moving average. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.